I've been with Aberdeen for 26 years. I've been involved with Murray International Trust for about 7 years. Just going to touch on a few things, just a reminder of what we try to do with Murray International, sticking to the investment objective, some of the things that we've been seeing in markets, some of the changes that we've made to the portfolio, and then the all-important and ever-difficult outlook in terms of how we see things moving from here. Murray International, I wouldn't say it's a boring trust, right? But it is a traditional income trust. It is tasked with delivering an above-average dividend yield, which we take as being the average of the AIC global income, excluding Murray International. That yield, we try to be above that. We try to cover the dividend from the underlying securities as well, so we're not paying out of capital. There's nothing wrong with paying out of capital. We just try to cover it from the dividend income. And then we look to grow the income and the capital in real terms over the long term. You'll notice there's no mention of a benchmark there. That's not by accident. There is a reference index from our international, but particularly in this day and age, you can't be tasked with an investment objective like that and then be hoping to keep pace with or being ahead of a global benchmark, because between 15 and 20% of them is made up of fantastic businesses. There's nothing wrong with these businesses. They're brilliant companies, but they don't pay dividends. So they're just not going to help me deliver that investment objective. That's not my investment objective. That's not Aberdeen's investment objective. That's the shareholders' investment objective. Trust belongs to them, and we're just tasked with delivering that. We've grown the dividend for 19 years in a row. With regards to that dividend growth ahead of inflation, we've managed that in 15 of the last 20 years. Obviously, inflation's been a bit of an interesting target the last couple of years, but it's been a 7% compound annual growth rate in the dividend. And then NAV return ahead of inflation in 14 of the last 20 years. And that comes out at a 10% annualised return, total return in sterling, which, if you compare to the long run of a global benchmark over the last 20 years, it's pretty much on that on an annualised basis. It's just that we're delivering that with more of your total return coming from income and without investing in any of the Mag 7. Again, nothing wrong with those companies. Clients are overly and plenty of exposure to those. We're just trying to give shareholders something a little bit different. Performance, these are just the numbers from the first 6 months of the year to the half year, and very reasonable absolute returns coming from our Asian exposure. You can see we've got 25% of the assets in Asia. We do try to be truly global. We don't really see, again, the benefit for us in having a quasi-US fund with lots of other international or pockets of international exposure around about that. Again, we're fully aware that shareholders aren't short of options in that regard. So we have a reasonable allocation to Asia, and performance that has been very strong there. Really driven by technology, mainly by the stocks in Taiwan Semiconductor, things like Connaghan have been really, really solid performers. US as well, again, driven by some of the AI stocks that we can gain access to. So stocks such as Broadcom pay a dividend that we can probably work with in terms of yield. It's got about 1.5% dividend yield. That's probably a floor for us. We don't go below that. When we bought Broadcom into the COVID sell-off, and Broadcom, when we put it into the portfolio, was yielding 7%. It's run a long, long way since then, and is still a very, very fine business. To the weakness and where there's been problems, and there are always problems in a diversified fund, that's what we spend our time focusing on. Latin America has been weak. We've got 10% down in Latin America, predominantly in Mexico and Brazil, and a little bit in Chile. And that's okay. A number of the names down in Latin America are more cyclical in nature, some of the material companies to the earlier presentation. And they've been a little bit softer, particularly on the currency front. We've had elections in Mexico, and that's fine. We go into these markets with our eyes wide open. Sometimes shareholders ask us why we even bother with Latin America. I've been involved with equity markets for 26 years. If we take the FTSE All World, the benchmark referenced earlier, If you look in the regional subcomponents of that, in the last 26 years, which region has been the best performing on an annual basis the most times? Because it's not North America. It's Latin America. It's been the best performing market in sterling 11 times in the last 26 years. The US has certainly done okay. And not to sort of play down the UK, maybe this will be its year, but it's been a long, long time since the UK market's been the best performing market. But just to highlight why we bother with areas like Latin America, they're very undercovered, and that's the opportunity for us. As mentioned, some of the more cyclical areas of the portfolio have been weak. That's been okay, with the exception of gold, silver, and copper. You know, China weighing on that a lot. Iron ore price has been weak. We also invest in SQM. SQM is a Chilean business, which is primarily involved in lithium. Again, China being weak, EV adoption, question marks over that. So the lithium price has fallen sharply, and the stock price has behaved accordingly. That's fine. That's the opportunity. They're cyclical businesses, and we understand why we invest in them. On the other side of that, a number of the tech names have been performing very well. Hon Hai, TSMC, and mentioned Broadcom. So we can gain exposures to growthier areas of the portfolio. We do want to do that, but they have to give us a level of dividend yield that we can work with. Just in terms of some of the positioning, we have pretty low turnover. We don't like trading for trading's sake. Some people would say that's because I'm a tight Glaswegian and I don't like, paying broker commission. There may be a fair point to that. Turnover as at the half year was about 8% of gross assets. That's normal for us. Unless, of course, markets give you an opportunity, and then you should be more active in that. Epiroc, just an example of, it's important to always appraise any investment that you have. No turnover is fine, but that has to be justified. And if an investment thesis has played out, regardless of what the investment is, then we have to act accordingly, as do yourselves. It's done very well since it was spun off after another Swedish industrial company that we hold, Atlas Copco. But the dividend yield was not really high. It has been making one or two acquisitions with regards to moving into the infrastructure space as well. We did have some concerns about something trading on 26 times in the industrial space, being acquisitive. If it's not given as the income, it has to be given as a capital. And if we're worried about downside, then we need to sell out of it. So it's just always about reappraising why you're investing in any business. Where do we hunt? We hunt where there's weakness. That's where we look for opportunities. Now, Mercedes has been very, very weak. A lot of the luxury company cars have. A lot of that driven by China. China's important for Mercedes. It's about 35% of volume. It's about 17, 18% of revenues. But rock bottom expectations, no expectations for any of them. It still generates reasonable cash flows as well. Generated 1.5 billion euros in the third quarter. Easily covered its 5.5 billion annual dividend in the second quarter. Did a 2.5 billion buyback in the second quarter as well. I mean, even that shareholder return in the second quarter is what? 16, 17% of the market cap of that entire company. So we'll always hunt for where there's weakness, and we'll get the timing wrong. Can always guarantee that. But as long as the investment thesis still stands, then again, that's the opportunity. So we typically buy in where there's weakness. Top 10 holdings. We've got a mixture of growth and value here. Broadcom, Taiwan Semi, Besi, lower yielding stocks, but big positions. We do our own research, and we will back our judgments based upon the research that we do, alongside some more traditional income type stocks. Grupo Sur, if you've ever been to Cancun Airport, they're the owner and operator of that. Great margins, EBITDA margins of 70%, probably EBITDA margins that you would see in a number of holdings in the technology fund. AbbVie on the pharmaceutical side, again, about diversification. AbbVie's key drug is Humira, which is used in psoriasis and arthritis. They also are the main manufacturers of Botox and fillers, of which I'm clearly an avid consumer of. Philip Morris, tobacco. Can't really argue with the cash flow generation capability of these businesses. And OCBC, a banking stock from Singapore, making full use of the globe, making full use of the sectors, trying to manage risk and deliver the investment objective. Very diversified by sector and geography, pretty even split between the main regions. We do have an allocation to emerging market debt, but it's pretty small, at about 6%, 5% in the UK, nothing in Japan at the moment. That isn't, again, a negative view on Japan or the companies there, but if we're coming out of sterling and we're going into Japan, we would have and could have continued to give a fair amount of that back in the currency. So again, it's just been mindful of that. We always look for opportunity. And again, very well diversified from the sector perspective. The outlook. Where do we start with the outlook? Yeah, there are cracks emerging in the US labour market. We are still of the view that there is a soft landing in the US. We think that they do pull that off, which would be impressive. There has been noisy data points that's already been mentioned, but we think that particularly as it relates to the labour market, there are explanations as to why some of the data points have been weaker. We're not saying don't keep an eye on it, but we're just thinking that it's explainable in terms of the environment that we've been in, and again, something to watch. So there may be cracks emerging. Watch the stats from here. Nobody's really basing any major investment decisions on any of this because it is very difficult to factor. And as mentioned, we do think it's coming down towards a soft landing, getting back towards a more sustainable pace of growth. But as mentioned here, the survey data has been mixed with regards to manufacturing sectors, PMI. So mind your eye, but we are of the view that all other things being equal, and there are a number of uncertainties coming down the road, that they do pull off the soft landing in the United States. With regards to the election, yeah, it's going to be very tight. We still have it at around 50-50. It's easier to factor in, we believe, what happens in the case of a Harris victory. I think it would be largely a continuation of what we have seen. We do think it's obviously going to come down to the battleground states, and even somewhere like Pennsylvania could end up probably deciding the whole thing. So these things are interesting, but it's just noise. It is noise. It really comes down to listening to the companies and the businesses and how they're going to react based upon the outcome. Why it is so difficult is because we've got 3 different probabilities of if Trump wins. I don't know if that says a great amount about the man himself, and that you've got 3 different things that you could potentially try to contend with. Trump could be positive. Trump in the first 18 months of his first presidency was very positive for markets. He cut tax rates from, 35 down to 21. That added about 7-10% to S&P 500 earnings in that year. If he comes in and he does that and he takes corporation tax levels down to 15%, that's positive. Small caps will like that. Anything domestic in the US will like that. But if he comes in and he starts doing things about trade war, then the market is not going to like it. It didn't like it the last time round. And there are elements to that which are potentially inflationary. That then has knock-on effects to how low and how quickly rates could go. And as has been pointed out already, quite a lot baked into global markets at the moment. There is a lot of good news in there, and we're just a little bit uncertain at the pace of rates and how far we get. Something to be mindful of. Emerging markets, as we saw for the earlier slide, we do have a reasonable exposure to emerging markets. They have been well out of favour, but we do think that there is earning stability, earning support there in certain companies. There is certainly valuation support in certain companies. And while there has been a pause with regards to the cutting cycle, we do think that they will get back to doing that. And where there is weakness or where there is lower expectations, for us that is the opportunity, and where we will continue to hunt alongside having reasonable allocations to all other geographies and sectors of the market. So emerging markets may be one to watch. That was all I was really going to say, just some of the highlights and some of the risks that we are trying to contend with at More International. Thank you for having me, AG Bell. Thanks to all of you for coming along, and I will leave it there, and if there are any questions, I can take them at the end. Thank you.